If you've ever found the perfect property, but your current one hasn't sold yet, you probably lost the deal. Most investors don't know there's a loan built exactly for that situation, and not knowing about it has cost people some of their best opportunities. In this video, we're breaking down bridge loans, what they are, how they work, who they're for, and when they make sense. This is CleartoClose REI, where we make real estate financing actually make sense. Here's the big idea. In real estate investing, timing is everything. The right deal doesn't wait for you to get your finances in order. A bridge loan is exactly what the name says. It bridges the gap. It gets you from where you are now to where you need to be without missing the window. So what exactly is a bridge loan? It's a short-term loan, usually 6 to 24 months. That gives you the capital to move on a new property before your old financing is settled. Think of it like a financial relay race. You need to pass the baton before the next runner is already in position. Who uses bridge loans? Mostly active investors and landlords who already own property with equity, meaning the difference between what the property is worth and what they owe on it. And they want to leverage that equity to move fast on something new. Here's a real example. Say you own a rental property worth $300,000 and you owe $150,000 on it. You find a great new property, but you need to close in 30 days. Your tenant has 6 months left on their lease, so you can't sell yet. A bridge loan lets you pull from that existing equity, close on the new deal now, and then pay off the bridge loan once your original property sells or refinances. Now let's talk numbers. Bridge loans typically come with higher interest rates than traditional financing, usually in the 8 to 12% range, sometimes higher depending on the deal. They're short-term by design, so the math only works if you have a clear exit strategy. That means you know exactly how you're paying this loan off, whether that's a sale, a refinance, or long-term financing kicking in. Lenders are going to look at the equity in your existing property, the value of the new property, and your overall plan. This is not a loan for investors who are figuring it out as they go. You need a clear picture of your in and your out. The biggest watch out with bridge loans is cost, because rates are higher and there are often origination fees, meaning the upfront cost the lender charges to set up the loan. The numbers need to make sense on both ends. Run the full cost before you commit. A bridge loan that eats into your profit margin isn't a bridge. It's a trap. But when it works, it really works. You don't lose the deal. You don't have to rush a sale and take less than your property is worth. You move with confidence because you have the capital to act. To recap, a bridge loan is a short-term financing tool that lets you move on a new property before your existing financing is resolved. Higher rates, short timeline, clear exit strategy required. When used right, it's one of the most powerful tools an active investor can have. Next week, we're getting into one of the most common debates in real estate investing: DSCR versus conventional loans. Which one is actually right for you? That's episode 6. DSCR versus conventional. Which is right for you? Don't miss it. And if this video helped, hit subscribe. We drop new episodes every week, all built around helping you understand the financing side of real estate, so you can move smarter and faster than the competition.